Okay, good morning and welcome to today's webinar. Today's topic is finding and evaluating IPOs. My name is Scott Latonin and I'm your host for today. I'm also going to be your product coach with MarketSmith. So today's agenda, we're going to look at a few different characteristics of IPOs or initial public offerings. We're also going to look at some traits that I like to use to determine whether an IPO is a higher quality or not. And then lastly, we'll take a look at a few historical examples just to kind of reiterate the point. Before we get started, though, just to look at the question window in the webinar panel, it's designed to accept all audience interaction through the computer. So if any questions do come up, just enter them in right here, and we'll have a brief dedicated QA session at the end to make sure that everything's covered. And lastly, a disclaimer that the content in this presentation should not be considered a recommendation to buy or sell a security, and that it's intended for educational purposes only. And so let's just take a look at the different common characteristics of IPOs. And so the way I like to approach IPOs is, one, they're going to have a high reward. And so versus your normal large cap growth companies or value stocks or whatever types of stocks you're looking at, these are going to be the most dynamic, the most innovative companies out there. They're also going to have high growth and very high momentum. And so these are just some of the characteristics that most IPOs are going to share. And so along with the high growth comes your potential for extreme price gains in a short period of time. And so not only are you going to get these high earnings and sales growth, but you're also going to get the momentum. And so with momentum stocks, they're usually going to be trend stocks or a fad stock, ones that are extremely popular, ones that tend to be chased by average investors. And so we need to kind of look back and say, okay, where's the best place to get into these stocks? But that's the allure of looking at IPOs, is that you do have this potential for extreme price gains. However, we all know that with high potential for reward comes your high potential for risk as well. And so we also need to look at the increased volatility of returns. If we take a look at the best kind of way to look at this increased volatility is to look at the weekly spread on an IPO. And so normally you're going to see a spread of about maybe 5 or 6% on a normal stock. With an IPO, ones that trade within the last year or two, ones that just started trading, you're going to see increased volatility. So these spreads can be up to 10 or 15% from high to low. And so that means that you need to look at the stock and say, okay, well, I'm up 15% on the stock right now. It would be absolutely normal for the stock to trade down 6 or 7 or even 8% in 1 week. And so you just really need to be aware of what kind of risk you're taking on and how much expectation of loss you have in a given week. And so not only do you have increased volatility of returns, but you also have the potential for secondary offerings. And that can be extremely frustrating, especially because most companies, their management, their inside owners of shares are going to be doing these secondaries. They're going to be selling equity in the company at new highs in the stock. And unfortunately, that's where we'd like to look to get into stocks, is near new highs. So unfortunately, that when we're looking to buy a stock, management and insiders are looking to sell their equity in the company within these secondary offerings of stock. And so that's just kind of one of the downsides of investing in IPOs, is that potential. And so not only do you have the potential for secondary offerings to increase volatility, but these high expectations of earnings and sales growth and momentum, that leads to increased potential for earnings disappointment. And so when you look at a growth story, when the growth starts to slow down or there's any expectation of slowing earnings in the future, the stock price is usually going to get hit pretty hard. And then once that growth is gone, the stock's usually gone, done as well. So we definitely need to be on our toes and look for sell signals on the technical side to get us out before the fundamentals really start to roll over. And so the way I approach IPOs is definitely more of a balanced approach. And so I'm looking to be vigilant with my position sizing. I think it would be, unless you have a ton of experience trading IPOs and a ton of experience in the market in general, and you're also able to quickly pull the trigger when you're wrong, you probably shouldn't have 50 or 80% of your account in one IPO. What I like to do is look for the best IPO out of all of the IPOs out there and look to get a decent position, maybe a normal position size like 10 or 15% in that one specific name. I'm not looking to buy 4 or 5 different IPOs. That's going to increase your portfolio exposure to IPOs. And remember, the IPOs are a lot more volatile, as we'll take a look at with a few different examples today. And so you really need to be able to control the swings in your account. And so you need to be able to handle those swings because they can be obviously very drastic. And then, like everything else in the stock market, timing is going to be everything. If you're getting in early, near the IPO base or the first stage base of an IPO, you're much better off than at like a third or a fourth stage, or even 300 or 400% above the original pivot, because once you're up that high, the growth the story tends to be kind of played out. But we'll take a look at a few examples when timing is definitely everything. And so as far as identifying higher quality IPOs, just a few characteristics that I personally use to look for, better names. I don't even know if this is like well accepted throughout the company or anything like that. This is just something that I do. And one characteristic is going to be market capitalization. I'm looking for increased company size even before they go public. Once they go public, I'm looking for in the billions of market capitalization. I'm not looking to trade micro caps, $200, $300 million company size. I'm looking for ones that have been an established brand for years. Then they go public in order to grow their company even more. And so now they're just using that money that they raised from the IPO to increase their sales, to increase their dominance in the space. And so having a big company is going to allow you to mitigate some of the risks of IPOs. And not only that, but with increased average daily volume, you're going to see increased liquidity. So what do funds look for, mutual funds look for when they're looking to invest in an IPO? They're looking to be able to get a decent position. And the only way they can do that is with increased liquidity. And so you'll normally see average daily volume, the better ones, in my opinion, are going to be in the millions of shares already, if not the high hundreds of thousands of shares per day. That's really the only ones that I'm going to trade. If it only trades 100 or 200,000 shares a day, I'm just going to pass on it. I'm looking for kind of the best one or two IPOs in the market. And another criteria I'm going to use is going to be earnings. And so I'm looking for companies that have a long-term earnings track record, ones that not just stable, but have triple-digit earnings or acceleration in the most recent, 2 or 3 or 4 quarters. So along with earnings are going to come sales. Same exact thing as earnings. You want your steady sales growth as well as triple-digit sales or acceleration within the last few quarters. And unfortunately, IPOs normally aren't going to have everything positive about them. In my opinion, the best IPOs will have all of these different factors, but some good ones are only going to have really strong revenues. Maybe the earnings aren't there yet, or they'll have really strong earnings without the sales. So it's definitely a balancing act as far as the positives versus the negatives. I think with IPOs, it really comes down to the fundamental story of the IPO, and that leads to the company-specific events with respect to IPOs. What kind of reputation does the company have, as well as brand awareness? Is it a company that's been around and dominating the space for a number of years? A few examples I'll have will definitely have those characteristics already. But in my opinion, with respect to the company specific, I think that's the most important, because the only way to really gain conviction in an IPO or hold on for more than a 20% gain is going to be if you actually know what the company does, you believe in it. Maybe you do it maybe you buy the product yourself, or maybe it's a restaurant and you eat there all the time. But if it's for example, if it's a Chinese company and they do internet security, well, that's going to be very different from a Michael Kors that sells handbags and all that other retail apparel. That's one of the examples for today, which is why I bring it up. But the first example we're going to tackle is going to be GNC Holdings back in 2011. And so the market capitalization, on this breakout or before the breakout, it was $2.16 billion, so it's already in the billions. Obviously, it's GNC Holdings. I think everyone's probably heard of it. They do a lot of the vitamins and the supplements and everything. But the 5-year EPS growth rate was 83% at this time. And here are the 4 quarters of earnings and sales figures before actually on the breakout. It actually broke out on an earnings release, so it includes that earnings release on the breakout day. But we can see that the earnings, the last 3 quarters, earnings and sales are both accelerating. Earnings from 36 to 60 to 69, sales 9 to 14 to 16. So the sales numbers aren't anything to write home about. However, they are relatively solid, and you're seeing acceleration along with the very strong earnings increases. And so, that's kind of gives a little bit of conviction that, hey, this can potentially work. This is a higher quality IPO, in my opinion. If we take a look at the daily chart, that's kind of going to bring up, the risks of looking at IPOs is that increased volatility. And so you can see the breakout day was a gap up, and then it actually retraced much of the gain. And the following day, is a big spread. And I mentioned that earlier, was with that increased volatility. The low of the day was 23. The high of the day was about 25.50. And so that's almost a 10% swing from low to high. That's a very big spread on the day. So your account may have, your position you may be down 4 or 5% on. Now all of a sudden you're up 4 to 5% on it by the end of the day. That's a very big swing. And then another risk factor comes into play here a few days after the breakout. You have a secondary offering announced, and the stock is down 2 or 3%. When it comes to buying a breakout, the stocks that I do best on, I'm never down on the position. Not even for a few minutes. I'm going to be up on it the entire way. That I feel like as soon as they do a secondary in this case, now all of a sudden you may be down 2 or 3%, and maybe you're a little bit more defensive at that point. However, everyone kind of handles losses differently, but that's a psychological factor that needs to be taken into consideration. But the stock is able to recover. Once again, this is the daily chart. And so the stock, runs up from 25 to 33. So we've gone up about 20 or 30% or so from the buy point. And then you get this gap up into new highs. And like I mentioned earlier, companies are looking to sell equity in the company at these new highs, which is why investing in IPOs can be dangerous, especially for us, because we're looking to buy near new highs. And so they do another secondary offering here, and the stock is down immediately 2 or 3% from that gap up. This could actually brings up another good instance of this is why you want to buy right, and you don't want to be chasing a stock. Probably buying on the gap up of the prior day was probably ill-advised if you did. It's not really breaking out of anything. It came down to the 50-day, a few weeks prior to that, which is probably the optimal entry besides the double bottom. But if we go forward a few months, we can see the stock did have a tremendous run, not tremendous, but 23 to about 45. So it went up about 100% in less than a year, which, if you made 100% in your account in the year, you'd be ecstatic about that. So that would be a good return on this particular equity. And so what we can see from this takeaway, though, is that, they did 4 different secondaries along the way. Maybe 3 if you held it up until near the end, but they had a 4th one in there as well. And so you can kind of get the impression that, companies tend to do this a lot, and that you need to be kind of aware of what they're doing and why they're doing it. I think it can help you manage your expectations a little bit better. But potentially the secondary offerings may have overwhelmed the demand for the stock in the market. Maybe the market came in, but that's why we want to look at price and volume to help us with sell signals, as opposed to these looking at fundamentals or secondaries. We want to just kind of let the stock tell us when we should be in it and when we should be out of it. But that kind of highlights some of the dangers of IPOs is the number of secondaries that they tend to do. The next example we're going to take a look at is Michael Kors back in 2012, right before the breakout. Market capitalization, a $5 billion company already. Return on equity was an astounding 83%, which is a phenomenal return on your average shareholder equity. And if we take a look at the last 4 quarters of earnings, at 275, negative 18, 183%, and then a positive 113%. And so, that meets my criteria as far as, okay, it has triple-digit earnings growth in the last few quarters. You might ask, well, isn't that negative 18% a big concern? And it's really not much of a concern. That's just one quarter. And it's just one quarter. If you had a material slowdown and earnings never really picked back up again, or if they stay negative, that'd be a huge negative. However, in this case, it went down 18%, and the following quarter it was up by 183, and the earnings trend continued. And then also you see really strong sales growth in there as well at 70, 50, 81, and 45. And so you're never going to have a perfect stock, so you always want to be balancing the negatives and the positives. Ideally, there's only 1 or 2 negatives. Especially with IPOs, I think you want to be a little bit more picky. However, not all IPOs are going to have the best criteria. I think just the 1 or 2 best ones are going to have what we're looking for. And so, here it is, the stock's gone on a tremendous move so far. Only a couple months it's gone from, 27 to 50, so it's gone up about 70 to 80% in, 48 days in this case. And they announced a secondary. And I think Michael Kors was a very frustrating example of secondary offerings. I know I had a lot of clients call and vent their frustrations with the management of the firm. However, that's just kind of the risk. You either accept those risks or you don't accept those risks. If you accept the risks of trading in IPOs, then you kind of have to take them as they come. However, obviously they can be frustrating, but it announced the secondary, and the stock went sideways for months before it was able to hit a new high. But earnings picked back up again. The stock's at new highs, and everything looks great until they announce another secondary. And so this kind of illustrates how flexible you need to be. And if we take a look at these last 3 days on the chart here, the stock one day gaps up into new highs, and the stock's up 10%, and it closes at the high of the day, which is an extreme positive. But then the next day it's down 4%, the following day down another 4 or 5%. And so this is where you really need to be flexible. You need to say, okay, it was acting great here, now it's acting terrible. If you're more of a shorter term trader, I'd probably be selling this. I don't want to necessarily sit through a base. It shouldn't have done this at this point. But everyone has to make their own investment decision as far as what they're looking to use to sell a specific stock. But that's the flexibility aspect of it. Is it acts great one moment, the next moment it acts terrible. Now you need to adjust your thinking and be quick to pull the trigger. And so, it does a third secondary a few months later at new highs again. And I think at this point, most people had probably written the stock off because, look, it had done 3 different secondaries. Most investors probably lost money on each different secondary. And now the stock sets up again and builds another base, and it breaks out. Well, what are most investors going to say? Well, I can't buy it this time. They're going to do another secondary. I don't want to lose money again. But in this case, most investors have been fooled, unfortunately, and the stock is able to go on a decent run, a relatively, quote-unquote, easier run than the earlier one. So now the stock's really settled down, and then it has gone from 60 to 100 since then, and now it's building another base right now, which will be interesting to see how it plays out. However, you really don't want to discount a stock because it does a secondary. You just need to be aware and manage your expectations. One of my more favorite examples is Crocs in 2006. The market cap at this point was $3.89 billion. The earnings estimate for the current fiscal year was 155%, which is a very big earnings estimate number, which is such a big positive. And it's at this point it's kind of breaking out of a cup with a low handle. The pattern recognition doesn't draw low handles, so it doesn't draw that handle there. But it's pretty clear low handle. We all know that most low handles are flawed, and that it probably won't work. However, in this case, the earnings and sales figures and the fundamental story were strong enough to overcome that technical flaw in the handle. And so one of my favorite characteristics of this IPO is that it actually did a secondary offering during the base. I think it's a misconception that all secondaries, that secondaries occur now, but they don't occur back then. Secondaries have kind of been going on for the duration of investing. As far back as I've studied a lot of different examples, and it's just kind of how you play those secondaries. But the secondary is announced, the stock builds another base, and it breaks out of that. And you can see that the initial base didn't work, but the second base that it formed did. And this is another key takeaway for me is that if the earnings and sales figures are that strong and the fundamental story is that solid, then you don't want to just remove a stock from your radar. You want to keep it on your watch list or your universal list, whatever you have in place to monitor stocks, so that if it does form a base eventually and it breaks out, then you're on top of it and you're aware of it since you already know the company. And if we take a look at these 4 quarters of earnings and sales, they're tremendously strong. 999%, 650, 122, 330. Sales are commensurate with the earnings. Regardless of what you think about the actual product, the Crocs shoe is not necessarily the prettiest shoe I've ever seen. Supposedly it's very comfortable. I've never worn them myself. However, regardless of what you think about the product, the earnings and sales were that strong. I think if you liked the shoe, then you would have additional conviction in the stock. However, that shouldn't preclude you from trading the stock if you have never used the shoe. But regardless, and so the stock goes on a tremendous move, from a split adjusted 15 to about 80, and that's 400 or 500% in about a year. I mean, that's a huge percent move, and those are the types of moves that we're looking for. But here we go again. This was the key kind of example of when the growth slows of a company, of a growth story, the stock's done. And so that's what you see, is that huge price bar down in, towards the right of the chart. They announced earnings. They weren't as good as Wall Street expected. The stock plummeted. And, so it took a year to go up 400 to 500%. And then in, 2 or 3 months or 4 months, the stock went down 75%, and you're pretty much right back to where you started in just a very short period of time. So, just with IPOs, you need to be quick to pull the trigger. When it stops acting healthy or normal, you need to sell it and take a step back and reevaluate. And then the last example we're going to take a look at is more of a recent one, which is FireEye, which actually broke out this year. So it came out of that cup base, kind of a strange looking cup with the left side, which is probably why the pattern recognition isn't calling it a cup, but it is a cup regardless. Market cap at this point is a $5.4 billion. And if we take a look at the earnings and sales figures, the earnings were actually negative and getting worse. However, the revenues were up triple digits for 3 quarters and then 95% for the most current quarter. It reported earnings on this gap up day, and the stock acted accordingly. But we can see that it did have a relatively strong fundamental story with network security and internet security, which was a very big fad and trend at that point in time. And we can see that the stock went from $40 to almost $100 in 10 weeks. So it's a big move in a very short period of time, which is, like I said, the allure of looking at IPOs in the first place. Is you see those moves on the chart and you say, well, gosh, if I just bought it at 40, I'd be up a double in my account in a very short period of time. Unrealistic in most sense of the word, just because you're not going to get the low, you're not going to sell it at the high. However, the potential for it is there, which is why we look at them in the first place. And so they announced a secondary at this particular time, and the stock has now gone from 90 down to 26, and it's up from since then, since this time frame that I snapshotted it. But that's why we want to look at price and volume to kind of tell us when the sell indicators are. But that's just the inherent dangers of looking at IPOs. They can go up quickly and they can come down even faster, and you just need to be aware of that. And so now that we know what kind of IPOs we want to be looking at, this is going to be the best way to find IPO ideas. So there's kind of 2 easy ways in MarketSmith to do so. So one is to just build a screen, and here's the 4 criteria that I use for the screen, and you can just kind of build that really quickly. If you need some help building a screen, you can always give us a call. We'll walk you through that process. But the IPO date is just in 2013 or later, a market cap over $1 billion, current price over 10, and a composite rating over 80. I use the composite rating versus any of the other ratings because it blends the earnings and sales or the fundamental picture with the technical picture, and so I'm getting a composite of both, earning the EPS and relative strength ratings. And it only brings back 30 stocks. And it's super easy to flip through 30 stocks, especially because we know that not all 30 of them are going to be A, buyable, or B, in the right place in the chart, or even C, have the requisite earnings and sales that we're looking for. So out of those 30, hopefully there's maybe 1 or 2 that you would consider to be a higher quality IPO, using the criteria that kind of laid out earlier. But, if you have other criteria used for IPOs and you've studied them yourself and you found what works for you, then, that's all that works. That's all that matters. And then secondly, the easiest way to find IPOs is to click on the Stock Ideas button at the top right of the MarketSmith chart, and there's a list in here in the report section that says top-rated IPOs. Just hit the View button, it'll pull up the list at the bottom, and you can flip through your stocks down there. So super easy. And then lastly, as far as putting into practice, just go ahead and do your own research on IPOs. IPOs have a tremendous amount of upside potential, but obviously there's downside risk there as well that you need to be aware of. So just kind of do your own research. Take a look at the earnings and sales of the better ones in the recent couple years, just so you have the earnings and sales figures on the chart for you. and just do some analysis for yourself to get a feel for how you would have traded them. Run some screens to find IPO ideas. I think when you're flipping through IPOs, I think it's relatively easy just to eyeball them and say, yep, that looks good. No, that doesn't look good. It shouldn't really take you too long to do that. And then lastly, go back and study some of the historical IPOs that I outlined today. There's others in Bill's book, How to Make Money in Stocks, that are covered. There's examples in the Top Stocks books that we publish that have IPOs in them. But the more work you put into IPOs, the more you're going to get out of it. And then since that wraps up the presentation, I'm going to actually turn it over to you in the audience. So if any questions have come up, I'll definitely stick around to answer those. Okay, the question from David regarding what's the minimum market cap that you would buy. I don't necessarily have a minimum market cap. I kind of mentioned that $1 billion was in the screen for a market cap. I think you really need to be flexible, and that's a good guideline. However, if there's it's $999 million market cap and it's just shy of $1 billion, I'm not going to not trade it because it's just a $1 short or $1 million short. I want to look at everything in context and say, okay, even though it's maybe maybe it's only 800 million market cap. However, the earnings and sales are off the charts. Then you need to make allowances for that. That's why you really don't want to be too rigid in your thinking. You want to be flexible and you want to be able to account for different things. Because, like I said, there's no perfect stocks out there. However, in my opinion, 99% of the best IPOs have met the criteria that I've found to be important that work for me anyway, I should say. Question regarding, would you make an exception for an IPO like Alibaba and buy on the first day instead of waiting for an IPO base? And no, absolutely not. I think as we've seen, even the most hyped IPOs can fail miserably. I mean, we saw one IPO, I think, about 40 or 45, and it went down to $18 in a very, very short period of time. And those are the risks that are easily avoidable. The secondaries aren't as avoidable, so there's enough risk in IPOs and trading those without buying on the first day. The first day, that seems is probably not the wisest thing to do. However, if that works for you, then I guess if you can make money off that, then that's all that matters. What do I think of the IPO screen in the MarketSmith Growth 250? Definitely just use that if that works for you. I mean, I've kind of built my own thing that works for me. If you've been going through that and you flip through it, and you like it, then that's all that matters. Okay, and that looks like that pretty much wraps it up. So if any questions come up going forward, or if you want to build some screens, or if you have a general MarketSmith question, just give us a call. It's 1-800-424-9033, or just reach out to us at reaches@marketsmith.com. If you do social media, we're on Facebook and Twitter. Our president, Scott O'Neill, will tweet things occasionally about the market if there's something important. But definitely, keep an eye out for those. But like I said, anything comes up going forward, definitely just give us a call or shoot us an email. On behalf of myself and the rest of the team here, best returns out there in the market, and have a great day.